name is Botha and I'm from the Accounting Standards Board. Today I'm going to take you through the principles in ED 151 that deals with the recognition and derecognition of land. And yes, this is a re-exposure of ED 139. So during my presentation I will explain to you what amendments the board has made and why the board ended up with the re-exposure of the recognition and derecognition of land. So starting off with the background to the project, the board during its post-implementation review project to IGRAP 16 and 17 obtained feedback from respondents specifically requesting guidance on whether land should be recognized based on legal title or whether land should be recognized when an entity controls the land in terms of applying the accounting principles. Questions were also raised around at what point should land be derecognized from an entity's financial statements. As a result, the board then agreed to develop an interpretation to specifically provide guidance around the timing as to when an entity should recognize or derecognize land from its financial statements. The proposed interpretation also provides guidance on joint control over land. What is excluded from the scope is the classification, initial and subsequent measurement, presentation and disclosure of land. Specifically because this interpretation deals with the point at which land should be recognized and derecognized from your statement of financial position. In accordance with the standards of IGRAP, the guidance indicates that land should be accounted for separately from buildings and other structures. And as a result, this interpretation also does not deal with the recognition and derecognition of structures. So what issues are addressed in the proposed IGRAP? First of all, should the legal owner of the land always recognize the asset? And what will happen if there is a custodian appointed in terms of legislation? Secondly, how will a right granted to an entity through a binding arrangement affect the entity's recognition of the land? Then, when should land be derecognized as an asset from an entity's financial statements? And lastly, how to account for land when there is joint control by one or more parties. The assessment of control. In order to assist entities to assess whether or not control over land has been identified, indicators of control has been developed by the board. These indicators is based on the principle in the local conceptual framework. The board has also considered the Ipsos B's conceptual framework in relation to the definition of an asset. The board has also considered the principles and existing standards of IGRAP around the control over land. So the indicators proposed in ED 151 is first of all legal ownership, and secondly the right to direct access to land and to restrict and deny access of others to the land. So what is different from ED 151 to ED 139? First of all, in ED 139 there were three indicators of control: legal ownership, the right to access land and to restrict and deny access, and lastly the existence of an enforceable right to service potential or the ability to generate future economic benefits. During the comment period to ED 139, respondents raised concerns around these indicators of control. The first one being that the existence of enforceable right had to be for a significant period of time. The next concern was in relation to the right to access and restrict and deny access of others and the enforceable right, specifically which one is more important. An example between the Department of Public Works and the Department of Defence was raised. The Department of Public Works have the right to access and to restrict and deny access of others because they are able to decide when they want to exchange, transfer or dispose of the land. On the other hand, when the Department of Defence uses the land for a testing facility, for example, they have an enforceable right. And because the land is not going to be used for anything else, they actually identified it as a significant period of time. So the concern really was, in this instance, who should account for the land, the Department of Public Works or the Department of Defence. So as a result of that, the board then reconsidered the second and the third indicator. So before we go into the discussion around the indicators of control, I just want to touch on the concept of a binding arrangement. The binding arrangement is important because this sets out the entity's rights and obligations in relation to the land. What is a binding arrangement? It's an arrangement that confers enforceable rights and obligations on the parties that are involved in the arrangements. One of the issues identified during the respondents was the existence of a binding arrangement. They specifically commented in relation to tribal authorities that there may not be a binding arrangement in place in all instances. So as a result of the comment received, the board then undertook various consultations, including with the Department of Public Works, the Department of Water Affairs, Rural Development and the Kiama Technical Committee. During these discussions, it was confirmed that in the majority of instances, a binding arrangement does need to exist, whether it's in the form of minutes, recordings, or a permission to occupy. And as a result of this confirmation, no amendment was made to the requirements in ED 139 that requires the existence of a binding arrangement. Therefore, in the absence of a binding arrangement, entities need to take the necessary actions to ensure that the binding arrangement is drawn up to confer the rights and obligations between the parties involved in the arrangement. What the board has added to ED 151 is the principle around the assessment of changes that are made to the binding arrangement. So ED 151 requires an entity to assess at each reporting date whether there were any changes made to the binding arrangement and understanding what the impact of those changes are on the initial assessment of control. So let's look at the indicators of control. The first one is in relation to legal ownership. So what is legal ownership? It's a registered title deed holder of the land, or it may be a change in the ownership recorded by way of an endorsement. ED 151 also clarifies that in the absence of the second indicator that deals with the right to direct access to the land, the legal owner will control the land. So what if there is a legal owner and a custodian appointed in terms of legislation? Based on the legal opinion that the board obtained and based on the requirements in legislation, the custodian is responsible to acquire, to manage, to dispose, and to direct or restrict the access of the land. And as a result, the legal owner's right has actually been transferred to the custodian. As a result, the custodian should recognize the land as its asset and not the legal owner. What we've also clarified in ED 151 is the fact that the custodian, in terms of legislation, cannot transfer land or any of its associated rights to another party unless that is the custodian. So in the example of the Department of Public Works and Defence, the Department of Public Works is the custodian in terms of the Kiama. And as a result, the Department of Public Works should always recognize the land as its asset because it cannot transfer the land or the associated rights to the Department of Defence. The second indicator of control relates to the right to direct access or to restrict and deny access of others to the land. This indicator is based on the principle of substance over form. In terms of the framework, it's clarified that if one entity is the legal owner and another entity has the right to direct or restrict or deny access of others to the land should be controlled by the entity that has the right. This right includes the ability to decide how and by whom the land can be used. Therefore, an entity should be able to direct the future economic benefits or service potential associated to the land. What's also important to note is that the right may not have yet been exercised by the entity. What is important is that the entity has a right to the land, even though this right has not yet been exercised. In order to assist an entity to illustrate whether or not the right to direct or restrict access has been assessed, the board developed further indicators to demonstrate the existence of a right. These indicators was included in ED 139 and has not yet been amended in ED 151. These indicators are directly use the land's future economic benefits or service potential to provide services to beneficiaries. For example, a municipality may direct a municipal entity to use land in a specific way in providing services. The next indicator is the right to exchange, dispose or transfer the land. And the last indicator is the right to use the land in any other way to generate future economic benefits or service potential. So typically this is where the entity will use the land to generate future economic benefits or in providing a service. So what has changed from ED 139 to ED 150? First of all, the second and the third indicator has been combined. And as a result, additional explanatory guidance has been included in ED 151. So when the entity is granted a right to use the land for a period of time, this right needs to be granted for an indefinite period. The concept of indefinite period links back to IGRAP 17, Property, Plant and Equipment, where the concept of indefinite use is identified. In addition to the right being granted to the entity for an indefinite period of time, the entity also needs to illustrate that it has other substantive rights. And these rights can be illustrated by considering the indicators of control that I've highlighted in the previous slide. Important to note that if control is not demonstrated, then an entity needs to consider whether it should recognize the right in terms of GRAP 13 that deals with leases, or whether another standard of GRAP is more applicable. So once the entity has now looked at the indicators of control around legal ownership and the right to direct access and to restrict and deny access of others to the land, it needs to make an assessment as to whether or not it controls the land. Based on that assessment, if it controls the land, it needs to recognize the land as an asset in its financial statements. If control is not assessed, then it needs to de-recognize the land from its statement of financial position. The IGRAP then also deals with the concept of joint control over land, and this is where there is an arrangement between two or more parties to share control over the asset. In this instance, the IGRAP indicates that the entity needs to apply GRAP 18 that deals with interests in joint ventures in accounting for the land. The entity will recognize its interest in the jointly controlled asset according to the nature of the land. So if the land is then used by the entity to provide services, the entity will apply GRAP 17 to account for the land. In relation to the disclosure requirements, the IGRAP requires that where the entity is not the legal owner or not the custodian of the land, but control has been assessed, that disclosure should be provided around the carrying value of the land that is recognized as its assets. In addition, the entity also needs to provide key judgments and assumptions applied in order to assess control. Where the entity is the legal owner or the custodian of the land but concludes that it does not control the land, again disclosures need to be provided around the key judgments and assumptions applied. What's been included in ED 151 is to explain that these disclosures could be provided in totality, individually, or per groups of land, as long as it provides relevant information to the users of the financial statements. With regard to the transitional provisions, the proposed interpretation clarifies that on the date of adoption, an entity needs to apply this interpretation prospectively to binding arrangements that relates to land. Any adjustments needs to be made against the opening accumulated surplus and deficit. And if the acquisition cost is not known, the entity may determine a deemed cost to be the fair value in terms of Directive 7. The entity also needs to apply the proposed interpretation to new arrangements that are entered into after the date of adoption of the proposed IGRAP. With regards to the effective date, the board considered first of all whether additional relief should be provided in relation to the measurement period. But the board agreed to propose an effective date of 1 April 2019. And this is one of the questions included in the invitation to comment to ED 151. The reason why the board proposed an effective date of 1 April 2019 is first of all to allow stakeholders to update other guidance that's currently applied by entities, specifically in relation to the National Treasury on the guide on accounting and reporting for immovable assets that's applied by the departments. Also to allow the Department of Public Works to complete the update of the asset register at a national and a provincial level. Also, the board considered other financial management reforms that is currently being undertaken in the public sector, specifically the MSCOA. And then to allow entities sufficient time to make sure that they comply with the requirements of the proposed IGRAP, the board proposed the implementation date of the 1st of April 2019. ED 151 also addresses the adoption or the implementation of paragraph 17 in the leases standard. During 2009, the board undertook an improvements project but agreed to delay the implementation of this paragraph because at that point in time there were other guidance issued by the National Treasury. But because the principles in the IGRAP and in the lease standard both deals with the substance over form principle, the board is proposing to also require an effective date of paragraph 17 in the lease standard. Paragraph 17 requires that if a lease includes both a land and a structure element, each element needs to be assessed and classified separately as either a finance or an operating lease. The proposed effective date for paragraph 17 in the lease standard is therefore aligned with the IGRAP, which is the 1st of April 2019. Based on the fact that the board has combined the second and the third indicator, and based on the fact that the board is proposing an post-implementation date of the 1st of April 2019, the board agreed to re-expose ED 139, and hence ED 151 was issued. ED 151 has a comment period of 2 months, with comment closing on the 15th of December. The two specific matters for comment on which the board would like your views is, first of all, combining the indicator on the existence of an enforceable right and the right to direct access and to restrict and deny access of others to the land. And secondly, whether respondents agreed with the proposed implementation date of 1 April 2019. Thank you very much for your time.